So yeah, we'll start. It's 4:01. So welcome, ladies and gentlemen, to this quarterly call for our specialized portfolio. So today is Feb 29th, a very special day to discuss a very special portfolio. And we are almost at the end of our quarterly call series. If you have missed some of these, please subscribe to us on YouTube and follow us on our LinkedIn and social media pages so that you don't miss these updates. We discuss some very interesting portfolio ideas and market updates on these calls. So welcome Gagan and welcome to the audience. Before I leave the floor to Gagan, I'll just like to introduce Gagan to the audience today, and he'll talk about his portfolio that he manages. So Gagan has been with ASK since 2021, and he has an overall experience of 18 years in the equity market. Prior to ASK, he was with Kotak with Kotak Alternates in their listed equities fund, but so they're around 5.5 years. And prior to that, he assisted one of the French AMCs in India called India Advisors. And prior to that, he was with Batliwala and Karani Securities for 7 years. He has a postgraduate degree in finance from Department of Financial Studies, Delhi University. So that's Gagan for you, and we welcome him. And over to you, Gagan. Please feel free to take the audience through the fund and your investment thoughts. Over to you. So the format is Gagan will share his views and updates for the first half of the webinar, which is a 1-hour webinar, and post that we'll take questions from the audience. So audience, please feel free to post your questions on the chat. Over to you, Gagan.
Yeah, thanks, Sankalpo. Thanks everyone for joining in and welcome to the call. I'll put you through a brief presentation and I'll try to be quick about it, and then we can start the Q&A. So I'll just start the presentation with this slide because I think it sets the tone and the base for the entire conversation ahead. So, this rounds up the sectors and the year-to-date performance of the BSE 500 companies. It helps us understand why the stock markets have moved year-to-date the way they have. So if you look at the first row, quarter third performance, profit growth has been around 25% at the net profit level. And for the preceding 2 quarters, it's been 40 and 49.5%. That's very strong profit growth for BSE 500. But then again, if you look at sales growth has been relatively much softer, in the order of around 4 to 5% right through these 3 quarters, obviously implying that the movement in profits has been largely down to an expansion in margins. And again, if you look at the bottom row, you'll find that the margins have improved year on year for this set by 160 basis points and are now at the pre-COVID levels virtually. From here on, how does this move? Are there more margin levers? I think the margin expansion across the spectrum had a lot to do with cost inflation softening. And if you look at most commodity prices, be they chemicals or hard commodities, they have softened and now seem to be on their long-term trend line. So I think that lever of margin expansion is by and large through for most companies. So here on profit growth, probably be much more in line with how sales growth moves, and therefore we are possibly looking at a more temperate profit growth going ahead in the next year. So this gives you some flavor of how commodities, soft and hard commodities and oil price have moved where they stand today vis-a-vis their 52-week highs, and it obviously feeds into the gross margin line of these companies. All of this is well below the 52-week highs. Oil prices again are soft, and obviously we have had the windfall gains of Russian supplies helping us. The other important parameter which helped all the companies has been a softening of the freight cost, which had moved up very sharply. And while for the most part of this year that benefit accrued to the companies, now we've reached a point again where freight costs are rising, and that is obviously down to the Red Sea crisis. And the freight cost now is almost 30% up quarter to quarter. So by and large, and obviously, the interest rate movements have also globally have also something to do with a softening inflationary environment. Again, if you sort of further break down the growth of the companies in the BSE 500, while the aggregate is 5%, it varies very sharply across sectors. So clearly, auto components, and pharmaceuticals have had a very strong year. Capital goods have also had a very strong year, especially within the domains of railways and defense. On the other hand, pockets of retail, specifically apparel retail, have been very weak. IT services has had a weak year. Chemicals broadly has had a weak year, and that is largely down to a sharp correction in both commodity chemical prices and agrochemical prices, especially have had a severe beating this year. So a lot of variation in growth across these, and clearly even FMCG has had a relatively temperate and weak year. Obviously, these trends in certain pockets might sustain. So the order intake and order book growth in the capital goods segment seems to still be strong, while the prices have moved fairly sharply in anticipation of that. In the auto side, the MHCV and the two-wheeler cycle has seen an uptick. There's pent-up demand that's flowing through. Chemicals, interestingly, my understanding is we are by and large seeing the bottoming of the prices, but the indications are clearly that the prices don't move up sharply from here. So the base is now set year on year. On this base, unlikely that further price erosions will happen. If anything, there will be some improvement, and possibly you're seeing a turnaround case in the chemical space. IT is a mixed bag. The total contract values of most large cap IT companies are now growing. If you look at the last 12 months total contract value growth, it's pretty healthy for most companies. Infosys, TCS, everyone's anywhere between early double digit to high teens in their last 12-month TCV growth, but it's not converting into revenues, and it's a waiting game till the time discretionary spends in American companies or American corporates come back. It'll remain a mixed bag, with investments being focused largely on cost takeout deals, which plays to the strength of certain incumbents rather than the new companies. So that is, broadly my assessment of these segments. Pharmaceuticals have had a very strong recovery in the US business because of the benign pricing environment and the softening solvent and API prices. That's part of that benefit is obviously not, on something that they will incur recurring on a recurring basis. But steady state growth hereon is still still a reasonable possibility in the pharmaceutical segment. And some of the segments where we've seen pockets of weakness this year in demand might well recover next year. So probably a sector rotation towards pockets of consumer and retail, towards IT and towards specialty chemicals is a possibility and in the offing. So I'll move ahead from there. We've already discussed, how the sectoral performances have been. So I won't go into this slide in too much detail because it by and large captures the same thesis that we've discussed. Which segments have done well, and the last one, which perhaps I haven't covered, is the BFSI, which has also had a good year for the top line. Loan growth, AUM growth has been very strong across the board for most companies. But there's an increase in cost of funds. There's obviously leading to a compression in NIMs, and there's also an increase in credit cost and basically, provisions have gone up, although marginally, and consequently that top line growth has not flown down in proportion to the bottom line. So this is the Nifty earnings growth, and the growth estimates still look fairly healthy for the coming 2 years. And coming to the portfolio and portfolio changes, we'll discuss the portfolio changes in context of sectors. We've tried to see in which pockets we've been under indexed, and we think that there are themes to be played, and we've tried to rebalance the portfolio to a certain degree, basis that. But primarily, we've tried to keep in mind our thesis that we want to be in companies which are largely promoter driven. Promoters have skin in the game, have motivation for growth, and a larger chunk of the growth, if not the complete growth, is coming from secular themes, either driven by promoters' vision for growth or by addition of product basket and so on. So you can see we've increased our exposure to the capital goods and defense segment. We've increased our exposure in the oil and gas space, and we've added positions in the healthcare space. Just to put into perspective, the performance of the portfolio holdings vis-a-vis the Nifty holdings for the quarter, you can see we tried to target a concentrated portfolio with higher growth, and it's borne out in the quarter's performance. And this slide gives you a flavor of the valuations. Clearly still a standard deviation or so ahead of the long-term means, to a certain extent justifiable in my view. And this gives you, some flavor of the portfolio composition in terms of financial metrics, in terms of the capital efficiency of the companies. Compares favorably with the benchmark. The earnings growth, which obviously is our focus, also compares favorably versus the benchmark. And the valuations too are slightly on the higher side. Again, the earnings growth adjusted PE would probably not be higher, because on the PEG ratio, the portfolio valuations wouldn't be at a premium to the benchmark, given the higher growth that we expect in the portfolio. So this again gives you a flavor of the companies that we've added to the portfolio. You can you can see largely the areas, where that we've entered. We had gaps in retail. We've added Aditya Vision there. Another promoter-driven, retail in the brown goods space, 45% of their revenue line coming from largely retail of air conditioning and refrigeration products, largely east-focused, in fact, entirely east-focused segment. So they're very strong in the eastern states of Bihar and Jharkhand, and building up a presence in adjacent areas in eastern UP and Chhattisgarh. Unit economics we found were better than comparable listed peers, and a strong emphasis on the cost. At a unit level, the ROC is very healthy, and the SSG is also pretty strong. So a company which at its base of 145 odd stores, adding another 30 odd stores annually, and targeting 20% to 25% growth in the top line, and margins can sustain where they are. So that's the story briefly in Aditya Vision. Bharat Electronics is a defense-focused addition we've made. Why specifically Bharat Electronics? Because in our assessment, this is one company which can play defense capex in all segments. So if there is addition in the ship in the military naval shipping, whether it's addition in aircrafts or on the land assets, Bharat Electronics has a play across the board because of the strategic electronics that it does. In ships, it does sonars, missile systems, fire control radars. In aircrafts, obviously avionics, radars, and the electronic warfare suite. In tanks and guns, gunners control sites, IRSTs. In missiles, they have a lot of work. So the most broad spectrum player. Good order book and a very strong order inflow in the year. 30,000 crores of order inflow so far in the year against a guidance of 20,000 crores. And an order book of 80,000 crores. This year they'll close with a top line of 20,000 crores. So 4 times this year's sales is visible in the order book. Decent pipeline with very large missile projects. QR-SAM at 40,000 crores, MR-SAM 20,000 crores. So the missile portfolio alone gives a visibility of 60,000 crores of orders. And there's obviously more work to be done because HAL has received orders and acceptance of necessities for combat aircraft and helicopters, where avionics will come from Bharat Electronics, and in future radars also. So visibility for the long horizon and broad spectrum. They talk of sustaining margins at the current levels of 21 to 23%, and the management is comfortable guiding for at least a 15% top line growth for the next 3 years, and possibly beyond also. So that is our addition in the defense space. In the pharmaceuticals, we've taken exposure to Mankind, strong promoter-driven company with the best, arguably the best domestic volume growth in the Indian pharmaceutical markets at a decadal level. In the last 5 years, 2 probably figures in the top 5 companies as far as volume growth goes. So the thesis in Mankind is fairly simple. They've in the past traditionally been very strong in acute therapies, but they are building out their portfolio in chronic therapies. Their chronic therapy growth is 1.5x IPM. Their acute therapy growth is 1.1x IPM. Chronic therapies tend to have gross margins of 10 to 12% higher than acute therapies. So if they are able to execute this growth, it will be margin accretive. So my assessment, top line growth will be early double digits with gross margin expansion and operating leverage via PCPM or yield per man per month improving. Margins will improve, and we'll see a good bottom line growth, probably towards high teens to 20%. CAGR in this company. And we've added REC. We've discussed REC HBL in the past webinars. REC again is linked to power sector capexes where the government has laid a lot of emphasis. So a lot of pipeline is clearly visible for thermal power addition. Clearly. There's already 6 or 6.5 gigawatts of orders where BHEL is L1, 10 gigawatts of tendering underway, and 10 gigawatts of ordering or tendering, which is in the pipeline. And the government and CERC talk of adding at least 50 to 60 gigawatts of thermal power in the coming 5 to 6 years. REC is the nodal agency for both the distribution and generation related financing. It is also building up a presence in rooftop solar and also adding up to their portfolio on the infrastructure and hospital assets. They've seen a lot of write back of provisions which they'd made in the past on some of the slow-moving projects, which are seeing recovery, and that is evident in the commentary of BHEL. Government has laid a lot of emphasis on restructuring the distribution entities, making them more viable, and that's helping the quality of underwriting for REC. Their cost of funds are also stable to reducing. So we think, again, a long runway of growth available for REC at very stable financial metrics. Syrma, again, a company which is very active in the electronic contract manufacturing space. So if you look at the promoters of Syrma, the Tandon family or the Tandon group, very storied past in this space in India. Mr. Tandon was the IBM head in India for IBM, right up to the 1980s. They were the largest supplier of floppy disk heads to IBM, and Tandon Group is also known for incubating a lot of fintech and electronic contract manufacturing assets. In fact, they incubated, built up, and spun out and sold off one electronic contract manufacturing asset to a global biggie, and this one is their second venture in this space. Clearly, a sunrise sector growth visibility is evident in the order book, and the management talks of sustaining 35-40% growth in the coming years. Where they have room for improvement is on the margins and working capital. So this year they've doubled their assembly capacity. They've brought in 2 new facilities. They used to service the Western Territory from their northern assembly plant. So some of these things, cost efficiencies will play out in the coming years, and working capital. They do talk of trying to improve the terms, and shrinking the cycle from 70 days down to 60 days. So this is one where the promoters had a strong background and it's a sunrise sector, and therefore we thought it would make a good fit for our portfolio. HPL, again, a strong play on the railways, upcoming railways train anti-collision system capex, which is going to be fairly large. So they, along with a couple of other companies. So today, HBL, along with Kurnex and Meda Drives, are the only 3 qualified companies for doing the TCAS systems in railways. And HBL traditionally has been an industrial battery supplier and a defense battery supplier. this year has been very good for their industrial battery business, courtesy, the telecom capex and the data center capex. And obviously, the softening in nickel prices has also helped their cause. In the defense segment, they are actually seeing a lot of interesting demand both locally and globally. This is because in the defense battery space, especially the PLT batteries, there's only one supplier globally apart from HBL, which is a French company. Obviously, the fact that there are 2 or 3 parallel wars or localized wars sort of happening, which has restricted the supply chain, works in favor of HBL now. In the past, this is a space where they were not really exporting, but they have in this year managed to break through and do very well there. They've also been given orders for lithium-ion batteries for submarines by the Indian Navy. For the TCAS systems, they have visibility for a good doubling of revenue next year. And if you look at how TCAS ordering is sort of building up 6,000 kilometers of tenders to be bid out in the next couple of months for the next financial year, which goes up to 9,000 for the year thereafter, and then 15,000. So clearly a good growth space with fairly good dynamics. While some large companies like BHEL and Siemens have talked of entering this space, they will have to pre-qualify their systems and also show interoperability with railways RDSO equipment before they are able to break ground here, and that is at least 2 to 3 years away. Again, a good secular growth opportunity, and that is rational for adding in this counter. JSW, unfortunately, we couldn't build up an optimal sized position while we made good money. Because we couldn't build up an optimal position, we exited. These are some of the other exits, bases where we thought growth is good and where growth perhaps might soften, and where we are better off reallocating away. So we've cleared out our position in PI, which is one of the recent exits we've made. While a storied past and a very strong past track record, there was clearly a dependence on one single product, pyroxasulfone, one single company to whom they supplied QMI. So this one product was almost 3/4 of their custom synthesis exports. So this is one very large product, not only for them, but for the company to whom they supplied QMI. And QMI, clearly indicated in their most recent investor interactions that for the next 3 years, they don't see more than a 4 to 5% sort of a growth for that one product. While PI still remains positive because they have added six to 7 new products in their basket, those products may not be able to replicate, the kind of scale that this one product had. And because of that issue, from a risk perspective, we thought better to exit our positions. The other ones we've already exited in the past, discussed in detail. Yeah. This gives you, just to round up, the performance year to date of the fund versus the benchmark. Yeah, I'm done with my presentation and we can jump into the Q&A.
Right. So Gagan, I'll request you to pull down the presentation so that we are visible to the people who joined in.
Okay. So
just stop sharing.
Okay.
I think we're good to go. So I'll try to take in a few questions from the audience. Audience, please type in your questions, and at the same time, I'll just ask a few questions that we have from investors taken earlier and a few of my own questions. So Gagan, we will begin with a lot of investors are exposed to this portfolio from ASK for relatively newer time period. Okay, that's most people ask what is different about ASK Specialized. One thing is that we've understood is concentration on a few focused names. But if you can just take us through how is this different from, let's say, our flagship IEP or growth in purpose and in thought. So over to you.
Yeah, so let me put it this way that you sort of pointed out the most fundamental difference, which is that we are trying to deliberately have a concentrated portfolio of holdings no more than 15. So 12 to 15 is our sort of guardrail for the number of holdings we'll have. So clearly, this is a product which is aimed at an investor who possibly has a relatively higher risk appetite, right? Which basically means from a psychological perspective, the investor is willing to hunt for higher return, and at the same time, accept the flip side of that hunt, which is that risk diversification will be suboptimal. Basically, risk diversification is optimal in a 20 to 30 stock portfolio. Obviously, this means that risk diversification is less, while we try to ensure that our sectoral exposures are such that we are not we don't go overboard anywhere from that perspective, or from the liquidity perspective. Those guardrails are always there. But our deliberate focus will be on promoters who have, as I mentioned and I reiterate, who have a hunger for growth, who have skin in the game, who have shown capital efficiency, and we'll play themes, but ultimately we'll play themes through a bottom-up emphasis on financial hygiene and promoter quality, so that that element of suboptimal diversification is taken care of by backing up managements or promoters who have a strong execution track record.
Right.
So that is in a nutshell, the thesis of the product.
Right. So Gagan, you touched upon sectors there. Okay,
Yeah.
so from a typical ASK portfolio, there are, in a specialized portfolio, there are a couple of sectors which are grossly underrepresented in the specialized portfolio. For example, finance is something that I can think of. A lot of other ASK portfolios will have as high as 25 to 30% in finance, and consumption probably. Okay, so in the specialized construct, in fact, we have had a few exits from finance and consumption. So what is the idea there? Is it to focus on the other side of the market? And what are your thoughts there? Is it by design or by chance?
So let me put it this way, that we have made some reallocations in our BFSI exposure.
Okay.
And those reallocations have been deliberate. REC, while being in that segment, is deriving its future prospects from areas where we think there is a lot of emphasis and a good demand supply gap, and clearly therefore growth is visible. It's also a company which has put its house in order in terms of its underwriting quality, also seen help from government emphasis on reform. So what pulled them down in the last cycle has been cleared up, right? Financial hygiene is there, and where they are focused now is clearly an area where secular growth is due, and therefore we thought it would make a good addition to to our portfolio, differentiate, and also play into the themes we thought are there for secular growth. You're talking of alternative energy, renewable energy. You're talking of coal-fired generation assets, and they are the nodal one in this sector. So that is the rotation. We've reduced our exposure in BFSI because we thought that the portfolio was slightly skewed. We were underrepresented in good pharmaceutical names. That was a clear gap which needed to be filled. We were underrepresented, or in the defense and capital goods space. We've made those changes. Retail, we've taken exposure to a retail company, and we've also altered our positions there. So it's largely, as I said, trying to understand sector rotations, but always, with emphasis on secular growth and promoter quality. That's how we would attempt to build the portfolio.
Right, fair enough. So we've got a few questions from audience here. We'll take. So Mr. Minda is asking, you've estimated higher profit margins in FY25, but moderation in valuation. So any reason for building that in? And I'll take another question. I'll just repeat it. I'll just say it out for you from Mr. Ranjan. So he's asked about Infosys particularly, but I have heard you maintain that deal momentum and repeat for IT companies and discretionary spending from companies in the West to reduce. But IT still represents a broad part of the market. Indian IT is a global leader. What do you estimate? When do you see that coming back to our portfolios because of growth or situations changing? So these are a couple of audience questions.
Yeah. No, so on IT, I concur, and I maintain, the fact that on certain lead indicators, things seem to be improving, right? We discussed TCV. There are cost levers too for these companies. They built up a bench over the last 2 years, which they have now sort of rationalized. So they have levers in utilization. They have levers in offshoring. All of those levers, though, are contingent to conversion of TCV into revenue, right? Because that is where utilization comes into play. So it's not that you can selectively, use one of these levers and maintain profit growth, because they all sort of, the fount of all of these levers is basically the top line growth. Having said that, as the environment improved, it would seem that the environment is improved. If you look at the commentary of some of the MNC IT outsourcing companies, on the margin, the commentaries are more benign and in fact improving. The obvious other supporting factor is, while interest rates may not inch up anymore in US, are we looking at a scenario where they come down? If they do come down, perhaps discretionary spends on IT projects will see an improvement. BFSI, which is the largest exposure for Indian IT, has in US has had additional troubles. They have had mark-to-market losses on their treasury book, which has impacted them last year. That clearly goes away. So is the environment or the hygiene factors required to enable IT-related investments improved? Yes, it has improved. Can we time and say exactly that this is the time when things will start moving hard, and therefore it is better to be present, and I completely agree there. We are clearly keeping a close watch there, and we will allocate to IT. We have some space, we have cash which can be allocated. We have in fact zeroed down on a couple of ideas. and we'll build up a presence in IT.
Right. And on the first part about valuations, earnings expanding and your expectation of P multiples either contracting or remaining same. So that's a question we've got from audience. Any way you want to answer that, Gagan?
No, so P multiples, in aggregate, as I mean, whatever evidence I could show, I put on the slides to show that in aggregate, this was a year where growth was driven by gross margin improvements for a large basket of companies. That is not growth which is sustainable. We cannot have year-on-year improvements in gross margins unless one is of the view that the commodities will soften from here on, which looks unlikely. Can there be scope for operational efficiencies? Yes, because as I said, the top line growth has not happened this year. Companies have seen margin expansions coming from gross margin largely. If there is a recovery on top line, the asset sweating improves across sectors, and you get operating leverage, and that helps you build up on your margin improvement. Gross margins remaining ceteris paribus. So that is the rationale in the thought that as we move into the next year, some of the segments which have had a weak top line growth this year will see improvement, and it will flow into operational efficiencies and give you some margin improvement. Obviously, this has been a year where valuations have been, fairly high, partly coming from that stupendous 40% profit growth in the first half of this year, and maintenance of 25% growth in third Q. But it has also been helped by, rotation of flows, from a country perspective. India is relatively better positioned. China, on the margin, positions been deteriorating. So there are rotations, sovereign rotations also, which impact flows. And we also see SEBI also taking a position that some of the mid and small cap movement is on the irrational side. So my assessment is, all put together, mean reversion normally tends to happen, and perhaps that is where P multiples might compress somewhat going ahead.
Right. So I hope that answers the question on Infosys and IT and P multiples. So we will take a couple of other audience questions. So Ms. Poonam Shah asks about Page Industries and Bajaj Finserv, both being very curious cases and both largely towards premium consumption in India, both these names. And that has always been a very interesting area for investors and us alike. So what are your thoughts on Page and Bajaj Finance going out of the portfolio? Right.
So Page, again, I concur with her that they are the bellwether in the area they are in. But while a certain amount of slowdown was attributed to them doing some sort of adjustments in how they do their channel stocking, going on an algorithmic route to channel filling rather than conversations with channel partners. Also talking of a down trading, in the segment. It's been a bit elongated. That would also have been okay, but then the valuations also don't leave you too much headroom for comfort, right? So, I mean, net, we thought that the risk reward, would be better in some of the other potential investments, and therefore, we shifted out. That is on Page, and the other one was Bajaj Finserv. So, a large part of Bajaj Finserv's value accrues from Bajaj Finance. We already had exposure to Bajaj Finance. We were looking to rotating our exposure in BFSI, out in BFSI and into some of the other segments. Partially, that was there, and also, as I said, we wanted exposure to high growth segments at relatively better valuations. So between these two, we thought it fit to build up or ship out of Bajaj Finance and one more counter and into REC.
Right. So that's I hope that answers your question, Ms. Shah. Gagan, this is again an observation that I made in the last few minutes. So we have added 8 new names in the last 6 months or so since September. So would you say this portfolio is more agile or looks at investment ideas for on a very regular basis and shifts out if there is some change in thesis more frequently than other portfolios?
So let me put it this way, that we have less headroom for making errors, right?
Because of the
we are a concentrated portfolio, right? While at all times our endeavor is simply to ensure that the thesis that we went in with is playing out or not. We don't want to be dogmatic about the position that we are building in. Neither do we want to be reactive. I know it's a fine line, and we're always, all of us in the investment community trying to balance, these two sort of cross purposes. And my humble submission is that is what we want to keep on doing. That we want to maintain our position and back the promoter, back our sectoral thesis if it's playing out. If, on the other hand, objectively, we assess and come to a conclusion that we were mistaken on our thesis or on our assessment of the promoter's execution capability, we'll try to rotate out. Ultimately, the idea is to be able to generate returns.
Right. Thank you, Gagan. That also answers another question asked by audience member, that what is the exit criteria? Gagan, what's the churn on this portfolio? Somebody on the chat has asked us. So if you can just quickly answer that, and we'll move to next questions.
I won't have it off the cuff. I'm sorry. Right. But I'm happy to supply that answer to him.
But sure. So we will get back to you on the churn. It's an anonymous attendee. So okay, so we'll move on to the next question, which I have from one of our clients. It is, what is your take on the, you've mentioned this again, and in the portfolio we have some capex heavy or capex beneficiary companies. Okay, so what's your point of view on the large capex that has been fueled and the expansion in the quantum of capex, government capex that has been coming in, and how do we want to play it in the portfolio?
So if you look at the portfolio construct, you'll find names like Polycab, KEI, right? You'll find names like APL Apollo, which, I mean, these are 3 companies which play the capex theme, but through derived demand. Their exposure is therefore, in a way, less cyclical. These are companies with very good working capital terms. They clearly indicate that the uptick in the railway infrastructure is really helping them and will keep on helping them. And they have other levers in terms of housing or residential or commercial construction activity. They have levers in terms of exports where they are getting qualified in newer geographies. So, one of the reasons we want to do that is to be able to play these themes, but play them through companies which exhibit lesser cyclicality and are exposed to the whipsaw movements of cyclical investments, albeit in a lesser amplitude. So some of the names are those. The other names, Bharat Electronics, Um, I try to lay out my thesis. It's clearly that they are exposed to the defense in the most broad-based fashion, and therefore, while if let's say tomorrow the submarine or the destroyer capex comes down, they still have aircrafts, they still have missiles to play from, and clearly from a competitive standpoint, they are well positioned, and so in a way we are trying to see the moats on these companies. While demand should be good, there should be some moats, and they should exhibit financially good hygiene. So all of these names have good financial hygiene, and so we round up our investments in that way.
Right. Thank you, Gagan. Another important stock in the portfolio is Bharti Airtel. Okay, and so I mean the company and the promoters have uh, fought the onslaught of Geo head on and kind of emerged through it with great vigor and wisdom also on running a capex heavy business, and now we're moving to 5G. What is your view on Airtel or the telecom sector? And do you think that it's the performance or the stock has peaked? And what's the view ahead?
So, they've had a strong year, and clearly, there could be let me put it this way, a temporal mismatch in valuations versus the profits. Having said that, clearly the sector dynamics is in their favor, right? Only two incumbents gives you a very nice pricing environment. They are upgrading their customer base in India. You can see that in the ARPU moving up. They clearly talk of a 25% headroom in improving ARPU from here on. Their capex for the 5G is by and large, at least the bigger bit of it is through, and therefore cash flow generation is improving. I would still want to be in this counter, and while I have taken some profit off the table, I believe it's a stock we should have in the portfolio.
Right. So thank you for that. We move to the next few questions. So IPOs again, getting some attention from IPOs. The IPO market booming, and again you see ads everywhere. JSW Infra was one of, I think, the earlier IPO picks that we did, and like you said, you couldn't build a significant position because of valuation. What's your view on IPOs, and what sectors do you think will you be again willing to look at IPOs in the coming months or year?
So, let me put it this way, that this year has been an outlier in terms of the IPO returns that people have made in the markets. If you go back in the long-term history, IPOs have not been very remunerative.
Right.
So we will not look at participating in. I think from a regulatory standpoint, we are a PMS, and therefore participating in IPOs for us is there's a restriction around that. I think AIF is a vehicle in which IPO participation can happen. So for us, we look at all those IPOs, but we look at them, with a lens of seeing whether they fit our portfolios, and subsequently can we build out positions in those counters, because we like the way the sector is moving, and we like the promoter. So we invested in Mankind, right? We couldn't invest in the IPO, we invested subsequently. So for us, irrespective of IPO or otherwise, the investment process remains the same.
Right. So fair enough. Somebody in the audience had asked it. I hope that answers that question. So Gagan, before we take your final comments, the last question that I would want to present from the audience on my side is that you've had an 18 years of experience in the equity markets. long enough to see multiple cycles, violent cycles. And this portfolio is a concentrated portfolio. And like you said, the risk appetite and the return expectation both are kind of heightened here. Okay, so for investors that are looking to are willing to get that, okay, how do you what do you suggest to them, and how do you advise they look at tough cycles in a concentrated portfolio, and what should they be prepared for if they're willing to come into this portfolio?
No, I think it's very simple, that because it's a concentrated portfolio, while we'll try to, take care of risk. I mean, as a custodian of someone's hard-earned money, my job is first to protect the principal. That is my belief. But I think clearly the volatility at times could be higher because, let's say a stock moves sharply on the positive or on the negative side, its contribution to the portfolio's return is that much higher because you're exposed to perhaps a 5-7% position rather than a 3% position. That's all. I mean, it's perhaps a mental makeup of the person, whether he's agreed to that trade-off or not.
Right. So we'll take your closing comments, Gagan, and then we will conclude today's call. Over to you.
I have no more comments to make. Thanks a lot for joining in. And it will be my endeavor to give you as rich a flavor of the portfolio and the markets as I can provide you, with my understanding. Thanks again.
Thank you, Gagan. Thank you to the audience for joining in. If you have any follow-up questions, please feel free to reach us at our the email ID is mentioned on our website. We will be happy to take more questions offline if any. Thank you. Thank you, Gagan.